I'd like to start out by saying that, I'm not going to be, super optimistic about our economy because it's not really optimistic. As you can see, our economy is recovering at the slowest pace compared to other economies in the region. You can see that compared to other ASEAN countries, our GDP contraction was actually the sharpest during the first 9 months of 2020. Um, and you can actually see that, for example, Vietnam has consistently grown. And this is quite unfortunate considering that we entered the pandemic with a very strong position. Nevertheless, we are not performing the best. Economic growth has been quite weak. So, I mean, notwithstanding all those bearish factors about the economy and valuations, I thought hard about this, but I believe that the market can and will still go up. And I will share to you the reasons why and the reasons why I think the positive factors will more than offset the negative ones. First is the availability of the vaccine, which will allow the economic recovery to pick up steam. Okay, so my feeling is yes, we're having problems right now, but once the country successfully vaccinates enough Filipinos, we'll see an acceleration of the economic recovery as Filipinos become more confident of going out and spending money. Okay, next, the valuations. Yes, I admit that stocks are expensive, but relative to bonds, we are actually still cheap, and I will discuss the reason why later. And finally, right now, there's an ongoing rotation into emerging markets. And the Philippines, being part of that emerging market basket, should benefit from this ongoing rotation. Okay, what are the risks to our outlook? First is challenges in the vaccination process. Second is rising inflation. And third is tightening by global central banks and the BSP. Okay, the 2021 economic outlook of the Philippines is not very attractive given the poor outlook for both consumer and business spending and delays in the passage of the tax cuts. However, we think the market can still go up on hopes that the availability of COVID-19 vaccines will help economic conditions normalize faster. Um, Valuations of stocks are still not expensive relative to bond rates. And finally, the ongoing rotation into emerging markets should benefit countries like the Philippines, because we stand to benefit, or countries in emerging markets stand to benefit the most from availability of vaccines, rising commodity prices, and the weak dollar. So investors can participate in the markets by buying dividend plays such as Globe, PLDT, and AREIT, or by buying companies that are still cheap that will catch up with the rest, such as Metrobank, BDO, GT Cap, and MPI, and some REIT plays or companies that may unlock value through REIT, such as Megaworld. And risk to the stock market, strong performance include challenges in the rollout of vaccines, rising inflation, and tighter monetary policy.
We are now in 2021 and we're coming from a major recovery. We've started the year a little bit on an upside, and here we are again on that same period that we've seen in the last 3 years, a typical turning point. We're going to be seeing next could be more of a consolidation type of a correction rather than, of course, a major market plunge. So I hope that that should be able to gear us up to be able to look for that opportunity, because if we do get to buy at the lower end of consolidation, it should be able to give us good gearing, and it shouldn't take too long to be able to exercise that. The majority of the stocks that are taking in the volume are non-index stocks. And if you were to look at the ratio between the index stocks as compared to the index stocks, which is here in blue, as compared to the non-index stocks, you're talking about 71% of that funds are going to actually smaller caps, which are non-index based. In fact, if you look at the second stat that I have here, you will also see it quite clearly that in terms of market activity ratio, and that's almost similarly to what you're seeing on the other side, but it also shows you the difference between index stocks and smaller cap or medium caps that are not into the index, and it's also showing between 64 or 36% difference in terms of an activity ratio. That means only 36% of index stocks are getting the volume, while 64% are actually getting the bigger chunk of the market. And to me, that's what I call flight from quality, because you're getting funds going from blue chips and going to more speculative type stocks. Not all of them speculatives, but at least non-index based. And that's hurting the index type of market, and that's the reason you're seeing a withdrawal. And it could also generate the fact that consolidation's more likely is to come. So in summary, although the US market shows its resilience, there are some markets that may really need to correct soon. Ours is already starting to show that. I'm quite wary of some other markets showing overbought signs and the trend fatigue, as I pointed out earlier. And the PSE clearly is showing momentum flaws as they are right now. And of course, the rise of what I call these new incredibles, which are the speculative stocks, are stealing the market's thunder and drawing necessary volume away from the backbone of the market, drawing that move from flight from quality issues into more speculative ones. The worry I have over that is, if these people trading those speculative stocks get caught in that, as let's say corrections from speculative stocks eventually will come out, and if they get stuck, it might be difficult to transfer back those funds that move away from the blue chips. So I do hope that we see more profit taking that will come into those issues so that they can remain profitable, and then eventually rotate that amount of funds back into the more significant issues that are lined up into the index. And perhaps after that time, maybe then by that time or after the consolidation's done, that we might see much more viable advances that we might see in the mainline issues. So do be prepared. A controlled correction could come, or a consolidation. I'm looking that resistance is at 7,500 range, or 74 to 76, and pullbacks could be within a range of about 6,700 to maybe 6,400. And I hope within this range would be offering us much better signals to be able to buy back into our market.
That should be a buying opportunity for you to come back into the market, or to actually enter, because a lot of our clients are still not yet fully invested or are lightly invested. So, this market can go up even if the economy is not doing well, thanks to low interest rates and ample liquidity.
I agree with April. As much as, of course, we want the market to be climbing forever, but this reality that corrections do come. And yes, I did see earlier on that a lot of our customers said that they were still in cash and waiting for an opportunity. You're going to get it. And you don't have to wait too long. You'll probably be seeing it within the next month or two. So please be ready and go ahead, gradually buy it. And again, as the chairman said, just be a bit more discerning going to speculative stocks, because what was that famous saying of yours, Chairman? People who trade penny stocks become penniless. So just be careful about that. And again, as long as you have a good head over your shoulders and you understand the merit of what certain things can come in, the opportunity to buy your stocks will be coming soon enough.